the changing regulatory landscape with respect to crypto ETFs. I struggle to see how it can change that much, to be absolutely honest with you guys, because let's think about it like this. First of all, why are some of the sort of procedures and general methodologies that have been established with regards to digital asset ETFs, why are they there? It's investor protection, market integrity, the whole surveillance sharing agreement thing. I don't see that sort of like going out the window. I think the SEC will still require a surveillance sharing agreement for any digital asset that is approved for wrapping in the ETF wrapper. And if you accept that, and then you go back to the whole DCO DCM thing, right? And then obviously that requires a CME futures market. So it's kind of like status quo, essentially, right? I think the only thing that's
Yeah, I think,
yeah,
but like, what if there's a framework that basically allows tokens to more clearly define themselves under their regulative purview, whether it's a commodity or a security? And I think that's where, if I'm trying to kind of see an example or a situation where, they basically can give you guidelines and say, look, if you've got this project and you've got
yeah,
these tokens and you're truly decentralized,
yeah, yeah,
and you're a commodity and you can
yeah,
issue out through a commodity regulator. You can have an ETF that's like a commodity based ETF, which is what these Bitcoin and Ether ETFs are.
yeah,
And then it becomes a question of, does the futures, is that still a requirement? Do we still need to
yeah,
have?
yeah,
But certainly, yes. I mean, I think you're right to kind of jump back and say, look, we had these surveillance sharing agreements
mm,
to protect market
yeah, absolutely,
manipulation and
yeah,
do all that stuff. And now, if we kind of turn the page, are we just going to just have a whole new framework
yeah.
that will ignore that, or will make that unnecessary? I don't know.
It seems unlikely. I mean, I don't know either. But and there is, of course, there are regulatory sort of aspects that are already in place. The Commodity Exchange Act, for instance, which the CFTC kind of sort of leans on for its purposes, it clearly defines Bitcoin as a commodity, and I think the
Can we
CFTC has,
talk
yeah,
about like how we have some issuers already jumping in with basket ETFs, trying to get those approved?
yeah. I mean, we can talk about that. Let's talk
Because
about that yeah,
that to me tells you, because that goes
yeah,
directly into what we're talking about, is
yeah.
that you wouldn't file for a broader basket if you,
Yeah,
believe that a futures market, a regulated futures market, was deemed necessary.
yeah,
So that's
absolutely.
happening. That's reality.
Yeah,
I don't know if it's going to get approved, but I think that's a really good thing to follow. I think you got to stay on
absolutely.
top of what their comments are on that, and they certainly haven't kicked them back yet. So
Nope.
they're still in the queue.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. I'm Ken O'Delaga, Head of Content, and as usual, I'm joined by my colleague, Gabe and Mark. So, hi guys, how are you guys doing?
Ken,
Good.
great to be here.
Yeah, excited.
Yeah, this is potentially going to be a mega episode because we have reached that time in the quarter when the research team, Gabe and Mark, put together their quarterly attribution report. And it's basically a market report, but it leans on the CF digital asset classification structure to tease out the major drivers of the crypto price movements in the market during the quarter. And also, of course, the team do pull out some additional insights of interest and of note that happened in the quarter as well in this major report. So it's going to be a special episode because it's been a special quarter, elections, 100,000 for Bitcoin, and a whole host of other stuff. Let's get this show on the road. If you had to encapsulate what we've just seen in that momentous 3 months or so in a few words or in a sort of like one single theme, what would that be?
If I had to distill this down to just a couple of variables, and this is in our title, it's we're talking about these policy pivots. So one, the monetary shift. We saw the Fed do a decisive 50 basis point rate cut in September. They followed that up with another 25 basis points in November, and we're looking to next week, eagerly to get the latest summary of economic projections and know what they're going to do, if they're going to do another cut or if they're going to make a pause. The second thing is the regulatory shift. So that's the second pivot that we're talking about, and that's talking about the November election. We saw, the Republicans and President Trump get reelected in what would be a very explicitly pro-crypto regime, which is certainly a pivot from the previous 4 years as far as the way we approach the industry and regulating the industry. And those have kind of created these twin tailwinds that are really permeating through the price action right now.
Absolutely. And Mark, if you had to boil the quarter down into a short paragraph, which I'm forcing you to do,
Yeah.
what would that sound like?
Yeah. So for me, it's a couple of things. It's those policy shifts, the monetary policy, the regulatory re-rating that we're beginning to see in the market, as well as on the fundamental side, the fundamental shift over the last few years. We've seen blockchain capacity expand. We've seen over the last 2 years things be tested, higher transaction throughput be needed for more applications. So we actually have the fundamental support on on terms of block space, as well as these regulatory tailwinds that are going to allow the space to grow and potentially see much broader adoption.
Absolutely. So let's dig into those two basic catalysts. I put down catalysts that kept giving during the quarter, because the crazy thing about this quarter is that it's kind of like two halves. We had the rate cuts, and then markets kind of lit the blue touch paper, as we say here, or the fuse. And we were off to the races already. But then we had this election as well. So let's talk about the rate cuts first. Let's divide that into sort of two sections. Talk about the rate cuts. What were the essential mechanics of the monetary policy regime change that had the impact that we saw on the markets right up to the beginning of the election campaign, if you want to put it that way?
So it's like a sequence. And so we saw the most aggressive rate hiking cycle since the 1980s. And then we've sequenced into a plateau, and now we're sequencing into the cutting. And that's the rate of change that I know we talked about in our Outlook podcast. That's very important for markets. When we start to see interest rates start to get priced into the market and yields start to come lower, that creates this effect of monetary creation. So it becomes easier for corporations, for borrowers to borrow money. And for institutions, it's easier for them to lend money because they have more willingness to do so. And it creates this perpetual feedback loop in a fractional reserve system where the money printer machine kind of starts to organically turn back on. That's bullish. And that's bullish for risky assets. It's bullish for sentiment. And that's kind of the start of the sequence that we saw there as far as the rate cuts. We're now entering a stage of the Fed rate cut cycle where we're trying to understand, are we going to continue on an autopilot, 25 basis points, which is what we called for in our previous outlook? Or is this persistently kind of sticky or higher inflation going to derail that and cause them to pause? Also, you have to take into account the fact that, with the Trump presidency and that mandate, there's likelihood that you're going to get tax cuts. You're going to get maybe higher deficit spending unless the Doge committee comes in and starts cleaning things up dramatically. But that's ultimately going to force the hand to, I think, bring rates lower, because you're seeing constraints on the borrowing, and we know the labor market's still fragile. So that's kind of like the sequence on the rate cuts. I think, we can talk about the election as well.
Yeah. I mean, I wanted to maybe get Mark to double click on one aspect of that. You choose. But I was thinking about rates. I instinctively sense there's a takeaway there with respect to the rate cuts and what we saw happening in the treasury market, which appears to have sort of like shifted away from a potentially risky situation that was beginning to occur with respect to yields. But I want to understand that a little bit better. And I know that you track that stuff, quite microscopically. So I hope, what else can you add to that for us?
Yeah. So when looking at interest rates, like remember the Fed's rate policy only affects the short end of the curve. So they're when they cut, it's just cutting the short end. The long end of the curve, that's a supply demand in the bond market thing. So the bond market's attempting to price, roughly where it thinks rates are going or with the term premium. So that move by the 10-year after the election to about a 4.5% yield, that was largely on, concerns that maybe the Fed couldn't cut as far as they might want to, because if you're going to run higher deficits, there is that almost a fiscal dominance to fiscal policy where that might kick up inflation, and you might want to essentially hit the brakes a little bit. But as we get closer and, the treasury picks are in and we kind of start to see, okay, maybe the deficit, they're taking that into account with who they've picked is what the market's kind of thinking probably. So, and the Fed's also come out and spoken since the election. They've given a little bit more clarity on the path of rates. They've talked about, the upcoming December rate cut and where they're thinking there and how they would think about a pause. And when you start to factor all that in, then you start to see the 10-year, I think, rightfully fall off. Ultimately, when you talk about interest rates, you're at a 4.5 to 4.75 when we're recording it. Any way you cut it, that's still a restrictive rate.
Yeah.
So all we'd be doing if we cut interest rates is going from restrictive to slightly less restrictive.
Yeah.
Yeah, we're not talking about going from restrictive to this is easy money and now we're going to see GameStop go 100x next week or whatever. We're not. That's not where we're going. We're going to. We're kind of starting to get the economy moving again and the private sector.
I want to, we have to be so careful because there's so many interesting things to talk about. We could sort of like get really down into any rabbit hole here. Clearly, where we are in the cycle on a secular basis, the broader context that's kind of like leans bullish, to say the least, right? Gabe, did you want to talk about the CME futures open interest, or do you want to move on? We can maybe come back to that.
Maybe I can give the audience just a brief overview of our index performance. So,
sure.
I mean, last quarter was nothing short of spectacular. So, a lot of the indices posted almost triple-digit gains, but let's just start with the top, the leader. It was digital culture, which has been a laggard throughout the year, surged 103.62%, led the rest of the market. Kind of highlights this shift into these more segmented specific categories that were lagging before, and now they're leading. So we see that also in blockchain infrastructure.
Yeah,
that's an index that posted a 82.3% gain. And then on the broader market, our free float broad cap index, which of course does not do any diversifying factor adjustment, it rallied 77.88%. But most notably, the diversified variant of the broad cap index was 23% higher than that 77%, was almost 102% up on that quarter over quarter because it has more of a smaller cap tilt. So this is very distinct when you compare it to the previous quarters throughout the year where we saw more concentrated gains. You'd see in that case, like the Ultra Cap 5 index, which is the kind of like the bellwether mega cap token index that we have, leading the rest of the categories. And in this case, the Ultra Cap 5 was actually the laggard, but still rose 72.69%. So still a great result, but technically slower than the rest.
Is it too early to have that takeaway or that conclusion that, there's a potential structural broadening of investor interest? I mean, we talk about institutional interest. I'm not sure if we can tease out institutional stroke retail, or can we actually say that now based on what we've just seen in the last quarter?
And one thing that I highlighted the other day on X is that there's this FOMO chasing right now that you see in Bitcoin, and certainly I think it makes a great deal of sense because I'm getting anecdotally lots of personal reach outs when Bitcoin hits 100,000.
Who knows nothing?
Nobody wants to talk to me about Bitcoin when it was 18,000 or 20,000 or something like that. It's actually cheaper. So I wanted to highlight something that if we look at the altcoin space, they're still not at all-time highs, broadly speaking. So there's opportunity for a catch-up trade. And this is something that we've been talking about in all of our publications and content, is this regulatory re-rating in digital assets. Yeah. So that's a significant shift. And it's kind of showcasing this altcoin outperformance in the catch-up trade. Whereas we saw this underperformance before, we're starting to see that reversal because of this potential regulatory dynamic that could come to the market.
Yeah.
I mean, yeah, I think I don't know if we're ready to quite call like maybe a sustained outperformance from altcoins, but one thing that I mainly in my main reason for that is just because of where interest rates are, and there is still some, despite we know who won the election and who they've picked for everything, there's still a little bit of policy uncertainty. We're not sure exactly how that's going to unfold, when that's going to unfold, and when everything will go into effect.
Yeah.
So without that, this could be a little bit premature. Come January, things can always change, right? But again, like as we start to move into a lower interest rate environment, and as we start to get that policy clarity, that's when I would really suspect or look for more of a sustained move, or see if we're going to confirm whether this was the beginning of the breakout or this was just a kind of catch up rotation back in.
But to Ken's point, let's just talk about some numbers here. So we've seen $52 billion going to the BTC, the Bitcoin ETF, spot ETFs here in the US. Almost 10 billion of that 52 was since the election. If you look at Ether, they've had 4.7 billion in total, 1.9 of which has come in since the election. So this is a material kind of
pretty conclusive.
reaction by markets. And that's a different category than the altcoins, right? There's no spot ETFs in these altcoins yet. So maybe there could be. But right now we've got Bitcoin and Ether that are greenlit, and those are trading with this investor demographic. You've got the altcoins over here, and they're seeing the catch-up trade happen.
Yeah.
Money's going, you can assume that money's being thrown at both right now because of what we know about the spot Bitcoin ETFs and the spot Ether ETFs.
Yeah. I mean, I think you said that, I mean, clearly they are different. There's different categories, right? But the commonality is regulatory optimism. It sounds like it's just like really silly phrase, but frankly, that's what we're up against, right? So what I wanted to ask you, guys, is are people too optimistic? There's expectation. Yes, we've mentioned we now know the term. This guy called Paul Atkins is the administration they put up for the SEC chair. Where we are right now on the date that we're recording, none of the hearings or committees have met. That's all going to be, I think, beginning in January. So yes, there's a bit of uncertainty, but I think some of these picks are pretty solid, unlike some of the ones that didn't actually make it to even this stage. Some of these sort of like financial picks, I think, are fairly solid, right? But we're not there yet. So that aspect plus just common sense. Regulatory optimism, is it too optimistic? And how much of that is actually a propulsion element on prices that we're seeing? How much should we actually really realistically discount maybe in a month or a couple of months' time?
Yeah. So when we're thinking about like the regulatory impacts, a great one of our indices to look at is if you look at the DeFi index and you look at what's performing in that index, it's largely Uniswap and Aave. And then if we double click on those those tokens, and let's take a look at the fundamentals. Uniswap is now trading over $50 billion a week, and even before the regulatory optimism, it was trading consistently $20 or $30 billion a week in volume. So there was a fundamental strength, just because of the 24/7 permissionless nature of the trading, and then the fees are relatively low on layer 2s. Those fundamental advantages it has were always there. It's just now that, hey, this might be not deemed illegal in the United States. And the other thing Uniswap can do, if you look at the protocol, when you make a trade through it, you'll pay a fee to Uniswap, and it will execute a series of smart contracts for the automated market making protocol to work. If you look at the margins on that thing, that operates at a 90% profit margin. And there was a community vote a while back that talked about maybe doing a fee switch where they would take some of the profits and kick it to the token holders. With a regulatory shift, I mean, that's possible. I mean, and who doesn't want to own a token that's going to give you a revenue share of essentially a business with a 90% margin that's growing at over 100% a year for the last 5 years? I mean, that sounds like a great investment to me at, whatever the market cap is now, around $10 billion. Awesome. Yeah, let me in on that.
Yeah, and
For
there's going to be
that's not financial advice, but yes.
Yeah, definitely not financial advice.
No, but I think Mark, you've made a really good point there, because it's about the real work use cases in this cycle, I think. And the fact that once you do get the regulatory uncertainty cleared out, which I think it's a fair question, kind of what you're saying is, will this materialize? I don't know. But it's certainly, the markets are going to adjust accordingly. And if you have to be an honest, person trying to dissect the situation, you have an asset class that's very volatile. You've had it run up considerably. Do I think that this is overdone or we've hit our limit? No, absolutely not. Do I think that it's high probability that we get pullbacks? And just like we have seen in the AI story, of course. Yeah. Once you set up expectations, the market's priced for the expectations. And as soon as there's any sort of adjustment to those expectations, the price needs to reflect that. And that's what creates these swings and opportunities. So if you're using that type of framework to allocate into digital assets, I guess you just have to be measured and understand your risks and not take it too much. But the reality is that, look, you've got, 21 million Bitcoin. You've got, I'm not sure how much, Mark, you can probably tell me how much is left of mine, but it's not more than 2 million or
1.1 million left, I think.
We still have all these new buyers coming in space. So it's a supply demand story. And, it doesn't mean that Bitcoin can't retrace, 50% from here. It has a volatility that averages between 50 to 70% annualized. So if you take that, you apply that to your math. Next year we open
that's the reality, right?
Yeah, we open it up 100,000. It could draw down to 50, certainly, and still get back to 100 or more.
But the whole idea of it being an opportunity is built in as well, right? Because we've seen this. Again, not financial advice. Okay, I think, guys, just from your commentary, you're now maybe chomping at the bit to talk about individual protocols. We've got a whole host of, we could actually mention. We've mentioned, obviously, Uniswap and maybe others. There's been a couple of other real standouts that we can't neglect to touch on. Maybe start with XLM, Stellar, and then we go on to the biggie, I guess, Ripple. Talk about that, maybe HBAR and ADA as well. Who wants to take Stellar and explain the mechanics of that ascent?
Yeah, so Stellar is a bit of an older protocol. So if you've been around the space a while, you probably saw in 2017 it was up towards the top of the charts. And where they've gotten pretty big is into the real world asset tokenization space. So their foundation's been doing a lot of work there. And the thing is, coming into the election and with an unknown regulatory situation, that real world asset tokenization, well, it was it's a good idea and it has potential cost savings. It's unlikely to go anywhere without the backing of regulators, because when you're talking about tokenizing stocks, bonds, or real estate, these are all highly regulated industries. And there's a lot of kind of red tape you'd have to cut through and a lot of boxes that you're going to have to check to be able to do that. So coming into a potentially more favorable regulatory regime for that stuff, now that that's on the table, there's just a massive re-rating on the valuation. I mean, it went from single digit billions to, it's up 5 or 6x now since before the election. And as with anything, there can be pullbacks and there can be, it could run further, but broadly.
What was the specific use case? I know there's been a lot of talk about FedNow and integration, or at least testing going on. The FedNow being the instant payments service run by the Federal Reserve. What was the specific integration? Do you guys know, or can you guys remember details?
Yeah, the FedNow integration. I don't think that was XLM.
Oh, okay.
That was HBAR.
Oh, okay,
that had the FedNow.
Yeah, I think you're right. Which we're going to get onto. So should we talk about HBAR? Because HBAR did have that integration, or at least it appears to be, from reports, undergoing a test integration with the Federal Reserve's instant payment system, which I understand goes under the umbrella term of FedNow. Who has got some details that they can chuck into the conversation about that?
Yeah, so what we found is there's this pay by bank alternative. It's an alternative to credit cards. It's called Drop. basically, and that does allow businesses to accept value purchases digitally, which includes stablecoins like USDC and also micropayments and HBAR. So HBAR is that native token of Hedera Hashgraph. This goes into the broader story of, I think, what we're seeing in real world adoption of blockchains and cryptocurrencies. And what we know right now is the dollar is basically the dominant cryptocurrency from a real world use case. The appeal for not just Americans, but more broadly, when you look across the globe, to get access to digital dollars, send that, cross border. If you're sending a remittance back, if you're working in the U.S. or sending a remittance back to your family, is a clear cut use cases, because anyone that's sent like an international wire knows how expensive and slow it can be. So having digital dollars in a regulated framework. So I think stablecoins is probably going to be the low hanging fruit for if we want to talk about what the regulatory picture will look like in 2025. I think a stablecoin bill makes a lot of sense. These projects that can help with payments, and this I think also kind of speaks to a little bit of XRP's rally, despite the fact that we saw Gary Gensler, publicly announced, which we all expected, that he would not stay in the chair seat, with the new administration. So that story, though, is the bigger story here, is that these tokenized assets, starting with dollars, next going with probably treasuries, fixed income, and then going through the curve of other asset classes, I think is the real big picture story here of why we should care, tokenizing these things.
Yeah, let's jump onto XRP. We can no longer put it off any longer. Now, outside looking in, so TradFi institutional investor would probably have a sort of inkling about XRP. They would know about the court cases. There's an ongoing court case. There's a partial ruling. I think it was last year. About the fact that algorithmic retail sales to individuals cannot necessarily be regarded as security sales. It was within a sort of like ongoing court case, so bear that in mind. But then there was a sort of the go-ahead for the SEC to continue with its appeal. And also, there's also an outstanding part of the original case as well, institutional side. How on earth can a sort of a token like XRP have all of that legal overhang, and see the gains that it's seen in the quarter? First of all, guys, sort of give us some figures and delineate how crazy this ramp has been, and then sort of like maybe go through the rationale that people who are buying are going through to actually continue buying despite all this stuff going on.
Yeah, I can start to unpack some of what's going on with XRP here. So first thing, XRP, they've been working on, so their main product, XRP Ledger, is designed for sort of cross-border payments for institutions. Like from the get-go, that was their initial design. Right now, coming into what is potentially a new administration, they are talking about launching a stablecoin, which is kind of what got people bullish. So you have a couple of things that happened. You had one, they had a lot of regulatory overhang. They won their court case back in October initially that they weren't a security. Of course, the SEC did appeal later on, but with the potential new SEC, how far are they going to go in that appeal process, and how much muscle are they going to put behind it? That's a separate question now, which kind of removes a little bit of the regulatory risk. And then another thing to kind of note about XRP and its token, we've kind of seen this sort of move out of it before. And what's fascinating is, and this is true for a lot of altcoins, is this is just the case of once momentum gets started on these things, it can be a hell of a drug, and it can take you a lot higher, a lot faster than you thought.
Yeah.
So if you just take XRP's value and you divide XRP by BTC, you can see that it's down something like 90. It was down about 99% against Bitcoin from its peak in 2018. Right now it's down about 90%. So it recovered a good chunk against Bitcoin in the span of like 2 weeks.
Yeah.
So
that's the relative math of underperformance, right? I mean, if you fall 50%, you think you need 100% to be back to where you were, right? That's
but if you fall 99%, you can go up 10x, and you're still down 90%. But as long as you bought after you drop 99%, you're good.
Exactly. Mark, Speaking to like the bandwidth and the improvements that we're seeing, maybe you can walk us through some of the scalability features that we're seeing on these layer one programmable networks.
Yeah, for sure. I mean, we've talked a lot during this about potential for adoption and things like DeFi and a regulatory unlock. But the thing we need to step back and we need to take a look at when we look at our Web3 smart contract platforms index is what's the throughput of all these layer ones? Do we have the blockchain capacity to even handle everything that's coming? And if we start in 2020 when we had our DeFi summer and we look at what we had then, we had Bitcoin 3 to 5 transactions a second. Ethereum back then was about 7 to 10 transactions a second. Cardano had just sort of launched its smart contract platform, but it was, a few transactions a second. So we were maybe only able to process 10, 20 to 30 transactions a second across all layer ones. Now, if we fast forward to today and we'll look at the theoreticals first. So if we look at Ethereum on the base layer, we've got about 15 transactions a second. And on the layer twos, several thousand on top of that. Solana can theoretically hit, it says 65,000. So we'll see if we can get there. But that's already a massive improvement over what we had. It's hundreds of times more block space. And if we just compare it to something like Visa, just for payments, is needing tens of thousands of transactions a second. We now have the block space that we needed 4 years ago to start processing payments at scale. And then when you factor in trades on decentralized exchanges, borrowing and lending, you actually need more than that. But we have a real shot this time at keeping up with the user adoption. I mean, if you remember during the DeFi summer, the fees on layer one Ethereum, it was like $200 to do a swap on Uniswap, any amount. So unless you were moving massive size, that $200 cost was a barrier to even use it. Now you can go on any layer two and pay a fraction of a penny. It means anyone with trading any size can now do this. You could, if you want to send $1 in stable coins, fractions of a penny. Now anybody can send $1 worth of stable coins, not just large payments.
It sounds like what you're saying, actually, Mark, is we are there in terms of where we expected to be or where we hoped to be in 2021 or even 2022 on the scalability side. Is that what some institutions or participants are actually reacting to beyond FOMO and the price reaction, beyond momentum? Is this actually having a sort of a real terms impact on the price and the sort of attractiveness or perceived attractiveness of those types of protocols?
I think so. And one way to think about this is if you look at the Solana versus Ethereum performance over the last 12 to 18 months, you've seen Solana has massively outperformed Ethereum. And then if you look at the on-chain activity, at the end of last month, Solana did over $300 million in network fees when Ethereum was under $200 million. So it's now surpassed by over 50% what Ethereum is able to take in fees, while charging only a couple cents on the layer one, where Ethereum's still over $1 on the base layer. So it's already beaten it in terms of cost, which means it's just doing massively more transactions a second. And this should help clear up the bottleneck we almost ran up to in 2020 with the DeFi summer in 2021, where when fees get to a certain point, it starts to actually destroy demand for block space. It's almost like oil prices. Like when you see oil prices get really high, over $100 a barrel, you'll actually see demand destruction for oil because, I mean, you're not going to, it's energy, the energy cost is just too high. So you'll start to reduce your output as a result. And we saw the same thing on layer ones. Maybe adoption didn't go as far as it could have 4 years ago because you just couldn't buy the block space for cheap enough.
Yeah. And you mentioned the base layer, actually, Mark. So I want to get into that a little bit. There's been a sort of abiding sort of like theme amongst certain participants that we've seen or we are witnessing the death of Ethereum. I mean, I don't necessarily agree with that, but I'd love to hear you guys quantify. I mean, one of the ways it's reflected, we only just saw Ethereum the other day retake 4,000 for the first time since March. And it's been a sort of like a long-term semi-structural thing whereby it's been lagging in terms of the sort of like the pace of gains of Bitcoin and other sort of altcoins. And that's led to some people saying, well, it's no longer all about Ethereum. To an extent, they're right, but clearly, where would we be without Ethereum? Literally, right? So, how would you quantify that a little bit in a bit more detail, chaps?
Yeah, for me, the death of Ethereum narrative seems to be coming from a few places. A lot of people are looking at the layer one, the fees that are being generated, and then how that's pushing through to staking yields and everything. And you've noticed after the Denkun upgrade, it went way down. And the reason is the way the layer twos used to work is they would roll up the data and they would be posting them to the main consensus layer. And it would eat into that 30 million gas per block limit, which would result in them paying a good amount of fees to roll up all these layer two transactions. When you move all of the data blobs out to a different layer, so now they have a separate blob fee market for these layer twos, the layer one fees came down and really compressed, as well as the layer two fees compressed. So you actually got to a comparable fee to Solana, but because of the demand destruction I'd previously mentioned, when it was expensive to use the chain, there weren't enough people using the chain to fill all that new block space that was created. If you look at the blob fee market back when it first started, it was about it's like 1 times 10 to the negative 16th decimal places per, it was infinitesimally small. And now you're looking at blob space fees at 13 Gwei. And 1 Gwei is the equivalent of 1 Satoshi in terms of Ethereum decimal places. So a 13 Gwei blob fee is actually about the fees that you're seeing on the base layer now. So now there's enough layer 2 activity to start posting enough blobs to create a competitive fee market there. And that's only going to grow as these layer 2s continue to launch and interoperability improves.
Right.
Well, a couple things I'd add to that. One, as far as concerns about Ethereum dying, if we look at some of the clear real world use cases, I think we've talked about so far, it is the tokenization of assets. And that's being done now by institutions. Of course, BlackRock has famously launched the Build Fund. Franklin Templeton's got their money market fund. But these institutions are picking Ethereum as their blockchain. So it's kind of like watch what we do, not what we say type thing. If you want to look at what's in front of you, the institutional choice right now is still Ethereum as far as the quality of the network, the decentralization of the network, giving people confidence to build on. And what Mark was saying as far as the way after the Denkun upgrade has allowed for these apps that are built on top of the chain to gain traction, harvest economic gains through the blobs and fees and stuff like that. But that's important, because if you think about it, you need developers to be attracted to your network. If you think about the App Store, the Google Play Store, it's where the developers want to spend their time, is where they can see the most economic value. So that's, I think, important. And I'm not saying that Solana's, out of the race. I think there's definitely a lot. There's going to be competition in layer ones, but I think that a lot of the fears about Ethereum being dead are a bit overdrawn. And that's largely driven to the price being lagging. But there's several facets that we can point to why I think Ether was a bit of a slower horse coming out of the spot ETF race. It has nothing to do with the underlying value of the network or anything like that.
I think that's the considered view. And we started talking about network upgrades, guys. So I think let's take the opportunity to talk about SUI, which obviously in the quarter, I think relatively recently in the quarter, launched the SUI bridge on its mainnet with an impact on price, a beneficial impact on price, because obviously that is very advantageous for the protocol and going forward for the adoption of the protocol. Can you guys give us a little bit more detail on what is particularly interesting about SUI for you?
Yeah, so for me, it's the big thing that I'm interested in. It's the speed, the settlement speed being a few milliseconds, and the throughput being really high. Those have been probably the two main frictions. So if we look at the group that's engineering this, a lot of them were the team that used to work on Facebook's Libra project before that got essentially killed by the regulators. So they've moved out and they've basically taken a lot of the core principles they had, which if you know thinking about the size of Facebook's network, that's 3 billion users, and it could have potentially been hundreds of millions of active users if they had a token running on there. So they had to build something that was going to be pretty much instantaneous settlement and able to take a lot of transactions, which is what this does. So it's no surprise to me that when they introduce an EVM compatible bridge and you're able to move some applications over to it, certain things that might require higher throughput are going to maybe try to find their way over there.
Yeah. So let's talk about blockchain infrastructure. How did that CF Benchmarks index do in the quarter? Because it stood out in many ways, right?
I mean, blockchain infrastructure had it had a couple of standout constituents within that index. We had ENS, our Ethereum named service token, do quite well on the back of a few upgrades. And importantly, Chainlink, who's a partner of CF Benchmarks, their token did quite well with a few pretty interesting announcements that came out right around or slightly after the November election. And the big one that I want to call out is they ran a pilot with the Monetary Authority of Singapore, aiming to work towards tokenizing mutual funds. And UBS was also a part of this. And they're specifically looking to address inefficiencies with manual settlements and those sort of things. But what's interesting about that is that it actually uses the Swift network as the settlement network, and then the Chainlink network is able to work with Swift as the data provider for blockchains. So if you're an institution, you don't need to worry about creating all these wallets or any of this stuff. You can just use Swift, which already exists, and get the benefits of the tokenization on chain.
Do you think that's the future then? Do we see that more of these projects are just going to try and figure out ways to kind of pipe into traditional channels? I'd be kind of curious to get everybody's.
I think so. I think that's probably going to be the way we have to go. I mean, Gabe, you and I both worked at large financial institutions. We kind of know how entrenched some of the systems, processes, and procedures, for good regulatory reasons, often are. So it's going to be pretty difficult to make the jump directly from everything in databases to everything on chain trading 24/7. There's going to need to be some steps that we take along the way, and we may never get to a fully on-chain future. It may not be enough cost savings to be worth all of the initial investment for implementation. So that's where these hybrid systems can come in, where we can take things we already have that work perfectly, and we can augment them with some of the blockchain applications.
Swift gets to sort of like a new lease of life. Who knew that was that'll be on the cards? Back to Chainlink. One thing that I noticed that you spent a lot of time on a reasonable amount of time to make me notice in the section in the QAR on Chainlink was these three initials, CRE. Now, who wants to explain what that is, and also the significance and also benefits?
Yeah. So the Chainlink runtime environment, if you think about like other runtime environments like JRE, Java's runtime environment, it's really a piece of developer tooling. It provides a way for developers to essentially deploy code directly on the Chainlink blockchain and creates a set of Chainlink specific code. And that's important for anyone that's looking to use Chainlink to integrate with their legacy systems. As you go to hire developers, if there's one kind of standard tooling that they all use, it makes it much easier for people to build skills that are transferable and can work across organizations.
Does this appear a lot of what you see with NVIDIA and their
It kind of is. It kind of works similar to like how CUDA works with NVIDIA.
And that creates obviously a nice economic moat. And so I think there's a recipe of success that is to be followed with creating some of these things.
Yeah. Should it catch a light and there be sufficient amount of adoption? But Gabe, I know you want to talk about basis, and we're going to talk about basis, but I remember there was another thing we need to talk about as well, and it's major. The correlation, if you want the secular or structural correlation, the major correlation between, let's talk, in the broadest of terms, crypto and risk assets, which essentially is equities, or more specifically NASDAQ, right? You guys zeroed in on what could be perceived as a potential or signs of a regime change in that correlation. Give us some details and also give us some additional insights on that.
Yeah, I mean, what you can highlight is multifaceted. It's look, the crypto correlation with the Nasdaq with yields is kind of a misnomer. I don't think people truly understand it. It evolves constantly, and so in certain regimes you can find, such as the monetary tightening cycle that we were in, you could find that, when you're taking liquidity out of the system, when you're increasing interest rates very aggressively, the yield becomes inversely correlated with the price of digital assets, and that also is true with the Nasdaq. Therefore, you end up with a positively correlated Nasdaq with digital assets and an inversely correlated relationship with the yields. Since the election, Mark talked about this right at the top, where we saw right after, we got the results, the 10-year yield spiked, but then so was Bitcoin. So how do you explain that? How do you explain the delinkage there? And it's just because, digital assets have these narratives, and that means that we're in an idiosyncratic, I think, regime that the markets are trying to get in front of and price in, that's allowing for a decoupling. And we have a great chart in our research report that talks about our large cap cryptos. And what we've done is we've benchmarked it against a global 60-40 portfolio that does not have any digital asset exposure into it. So just think 60% equities, 40% bonds. And we compare it to other, famous indices like the NASDAQ, the FTSE 100, global bonds, gold, commodities, or the Nikkei 225. And we can just measure the degree of the move that we've seen since from September 1st to December 1st. And what we've seen is that digital assets were kind of in this lagging quadrant from a relative strength and a relative momentum standpoint once you compare that to the other markets. And it's just completely kind of outpaced everything and become a leading category in these markets. And so we'll throw that chart up here probably for some clips and visual aids. But it just kind of shows that delinkage. So in summary, I think it's a bit too simplistic to always assume that there's these strong relationships. If you go to another slide, we constantly measure weekly correlations over various time periods across equities, fixed income, currencies, commodities, and other. And you can just see how the market really just doesn't have any too strong positive or negative. It's pretty uncorrelated across the board over longer term averages.
Yeah. With that answers what my next question was going to be. A very, very simple question, and I think a lot of investors, casual observers, so on and so forth, would have the same question. It's way too early, way too premature to talk about the loss of the decorrelated appeal of crypto, particularly Bitcoin, I guess, and tokens of that nature.
It's not too early. I mean, it's been the case that it's been decorrelated.
Yeah, no, I mean the loss of the decorrelation. Yeah, because the stronger correlation or the signs of what could be perceived of a stronger correlation could suggest to some that basically that appeal that it had, being a decorrelated assets, inverted commas, is either it's fading or it's likely to fade at some point in the sort of foreseeable future. But what you're saying, it's way too unsophisticated to think about the model in those terms, right?
Yeah, I think you have to consider other factors, other variables. And so I think, we're in a regime now that, as we stated, it's in a regulatory re-rating cycle. So we're seeing the altcoin catch-up trade that's broadened the participation in digital assets. So, throughout the first, let's just say 10 months of the year, altcoins haven't contributed, really any positive performance to our broad cap index. I mean, we ran the numbers and we have a great chart on it, but it just shows that for the majority of time, there were actually detractors on the performance contribution. So what we did is we took the contributions of altcoins. So in this case, we define an altcoin as anything outside of Bitcoin and Ether, and we measured the contribution of those returns of those tokens, compared it to the total index return, and it's these tokens, which make up, let's just say 10% of the overall index, contributed almost 20% of performance, throughout the year. And it's all been in this November kind of catch up cycle window where it is kind of this regulatory rating. And it's also helped that I think you've seen the monetary impulse change to be less restrictive.
Yeah, actually, Gabe, I wanted to ask you about, because it might have been a slip of the tongue, but you said in a sort of in this tightening environment, which I actually could believe. Would you say that, or I mean, you playing 3D chess with our minds here? It is essentially, from what Mark, harking back to what Mark said earlier, we are still in a tightening environment, right? Although outright policy at the top line is actually easing, or was that just a slip of the tongue?
Well, I think where we're at currently is above neutral. And if you think you're above neutral, you're technically in tightening
Yeah.
environment. But what I always talk about is the rate of change is important. It's what the forward looking view of the markets is. It's expecting further rate cuts, and even though we've seen some rate cuts get priced out of the forward curve, we're still, I think, seeing some 3 or 4 maybe for 2025. We'll touch more on that on our outlook once we do that episode, but
Yeah.
that's still kind of the case, and certainly a difference than no rate cuts or rate hikes.
Yeah, I was going to just say on the monetary policy side, another piece where we still are tightening is the size of the Federal Reserve's balance sheet.
Oh, of course.
We're still running off
Yeah.
25 billion
Yeah.
here. So, and when we listen to the Fed speak, they expect us to still be tightening for maybe potentially another couple of quarters. So that's something that has to be considered as well.
It's amazing. It's amazing to think, how are we actually in a sort of easing environment at all? Apparently we are. Okay, let's dig into the meat of, this basis picture. First of all, Gabe or Mark, tell us where we are with the basis right now. Obviously, we come out of an amazing period of sort of trading and market action with respect to Bitcoin, most particularly Ether to an extent. But the basis has roared back to the center of attention. What are we looking at for the Bitcoin basis? And I know we want to talk about the Ether basis as well.
Just to kind of take a step back, and when we talk about basis, what we're talking about is the price of the futures contract in comparison to the expected price of spot. In this case, we price spot very proudly with our Bitcoin reference rates, and that's what's being used by all of our issuers to basically support these ETFs that have been widely successful. And what we've seen is since the start of the year, particularly when you see bullish momentum and price action, the basis, meaning the difference between the futures and the spot, tends to diverge, and it tends to widen out. And that creates opportunities for savvy, sophisticated, leveraged traders to go in and capture that convergence. So basically short your futures and wait for that convergence down to spot and harvest that premium between the futures and the spot price. That's something that, we haven't really seen a meaningful basis expansion since the initial post ETF rally that put us into this range over the summer months. But obviously we saw a nice re-rating. Bitcoin hit new all-time highs, 100,000. We checked that box off. It came a lot quicker than we thought in our last podcast, but we're there. That's something that is typically associated with an aggressive enough move where you see basis expansion. And so, yes, we are in this contango structure. That's what we'll call it, where futures price is above spot price. And we have some statistics here where if we take like the average 10 period of the basis rates, it was 19.4% for Bitcoin. The median over our historical observation period, which goes a bit further back, I think into September 2023, is 11.9%. So we've almost seen a doubling of that. But what's really...
Yeah, sure.
Sorry.
Go for it. No, go for it. Go for it.
I think what's really interesting is Ether. So Ether, predominantly basis trading has been centered on Bitcoin. The Ethereum or the Ether basis rates have typically historically been meaningfully lower than Bitcoin's, and therefore not attracted, too much interest by these savvy, smart investors. Now we've seen Ether's basis actually start to surge. So over that same 10-year period, it's averaged around 22.5%. So above the 19% of Bitcoin's basis. and also above its median of about 10.9%. So the question is, is this gonna create a shift in the institutional arbitrage activity where we might see more institutions encouraged to kind of step in and try and arb that basis down? What we do know is we've seen open interest on futures surge. And if we want to compare the two, CME Ether futures, CME Bitcoin futures, we've actually seen the Ether futures grow faster than the Bitcoin futures in the month of November. They rose almost 70%, made a new all-time high of about 16,000 contracts from the previous all-time high, let's say around 10,000. Bitcoin rose about 22%, let's just call it, to about 41,000 contracts from the previous all-time high of 34,000. So the activity is picking up on Ether. Now, we do have to highlight that there's, leveraged activity, a lot of leverage appetite, and these leveraged ETFs that currently invest in CME Ether futures have seen a lot of inflows. That could explain that, some of that rise in open interest. But at the same time, we can't close the door on the fact that perhaps the hedge fund darling trade in the future could be an Ether basis trade. So we'll continue to monitor that and kind of see where that goes.
Yeah, can I get Mark to, this will be speculation, or, you're going to have some more facts than I do anyway. Talking about the cash and carry, what should those sophisticated investors that Gabe mentioned, the sort of opportunist, strategic sort of participants, what should they be looking at in the next few weeks and months to do next? I mean, obviously, we've known that this thing can, disappear as quickly, no sooner was it there, it's gone, right? But we're looking at a different type of beast right now on this occasion.
Yeah. So first, I think we should touch on kind of some of the distribution of what this basis actually looks like and what the opportunity is here. So we have this great chart in our QARs that Gabe put together. It's kind of the histogram. It's that distribution of basis. So what you'll see is a lot of the basis is kind of concentrated on Bitcoin in that 0 to 20% range. That's not really when you see, if you look at the levered funds net positioning reported to the CFCC, you don't really see the basis trade be picked up. You don't see a decrease in net positioning until you start moving to like the 20%, where that tail of the distribution really kicks in, where you see it go 20 to 60%. People are more interested in this thing once the basis is blown out to essentially the point of exhaustion. That's when you want to step into the trade, because it can mean revert relatively quickly. So and remember, these are annualized numbers. So you're looking at the front month contract. This could be a couple weeks to expiry, and you're looking at 40% annualized. So you're really looking at just a few points on the actual arbitrage. So what you want to do is you want to make sure that you're getting enough to make it worth all the trading costs and everything else associated with entering into this trade. But the thing that I've really found interesting on the Ether front is if you look over the last 10 days, sure, the Bitcoin basis has moved up. It's gotten to maybe 20%, which is historically pretty high for 2024. Ether, we saw a few days where it got up close to 50% there. That's almost a more attractive trade than Bitcoin. Now, the volume is thinner, so you're not going to be able to go in with as much size as you could on Bitcoin. But if you're somebody that's looking to trade a bit smaller size, Ether might be an attractive place to look, especially as we see more ETF inflows and we see more volatility out of the underlying.
Yeah, that's a good point. I think that the liquidity, that's the thing about the open interest rising, over the past month. That could be enough to where you can maybe see convincing, right? For people to consider that trade. Because 50% annualized shows you sprinkle some leverage on top of that. That's where it gets to be quite attractive.
Absolutely. Takeaways, guys. I mean, it's a bland word, but people are, human beings need takeaways. What am I going to take away from this? What major takeaways do you want to hand the viewer, the listener watching right now from this quarter? One of the most amazing quarters that crypto has seen, frankly, without exaggeration.
Yeah, for me, the kind of key takeaway from going through the market is that we're starting to see broader participation across the altcoin market, as well as different sectors and segments of the market. So, and going forward, these things, momentum can carry itself. So going forward, it's going to be good to kind of keep an eye on that and to monitor. And overall, again, maintain position sizing, think about volatility, and, maybe consider broadening your exposure a little bit.
Yeah, I would echo that because it's about the broader participation is something that I think we've yet to fully appreciate. We know Bitcoin's in price discovery mode. We know Solana is also in price discovery mode, technically, but Ether and these other tokens have lagged, to a pretty significant scale. And so as the asset class becomes more widely adopted, which I think a lot of this price action is trying to, reflect that, the case for diversifying and adding exposure to altcoins or some of these tokens that have historically lagged, it's becoming more compelling because you're starting to see how having even just a little bit of exposure to smaller cap tokens augmented with your blue chip staples like your Bitcoin and your Ether can give you a lot of advantages over the long run because of that asymmetrical return profile, which we like to highlight a lot. So I think that's the key takeaway. This is just a case study example of how that translates into real world performance. And it's something that's analogous to, traditional finance. When we think about, small cap stocks starting to catch up to large cap stocks, there's rotations that constantly happen. It's what makes portfolio management kind of exciting to do. And if you're interested in markets, you can follow along and subscribe to our research. And we're here to distill that down for you. So it'll make your life easier, right? That's what our service is, hopefully.
That's the crystal clear gold standard wrap up, Gabe. Wonderful. Okay, so yeah, thanks a lot, guys. That was I hope it sort of comes across as a genuinely enjoyable experience to actually go through that amazing QAR report for the final quarter of 2024, an amazing year for crypto. Guys, if you want to dig into the details, what you need to do, of course, is go to cfbenchmarks.com, navigate to the Research and Insights tab or link, click on that. The QAR should be the first report at the top of the menu. So that's where you need to go. And of course, if you've enjoyed the conversation that we've had today, you can, of course, find other conversations amongst our archive of amazing podcasts. Navigate to your sort of favorite platform, Spotify, Apple. We do have a few still on YouTube. Go there. And of course, do come back next time for another episode of CFB Talks Digital Assets. Thanks a lot for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.